Now,
Right.
there's this magic number, which is 47. 47 is the level at which it has a 100% chance of recession. Now, we're still in the 50s, low 50, but all of the forward-looking stuff is going down to 47 for the shorter term stuff, i.e. the next couple of months, we should go 47 and maybe below, maybe 45. But the forward-looking stuff gets down as low as 35.
All right, hello friends. So today I want to run through with you guys what I am learning from Raoul Pal, things that you can pick out. Again, he is one of the many macro investors with a certain viewpoint of the economy. Now, I think it's important for us to take a look at what he is saying so we can better understand from multiple perspectives on where the economy is heading, and then where can we position ourselves if we are trying to be investors for the long term, how you can take what he says and apply it to your investment and your stock portfolio. If you subscribe to the way he views the economy, that's what you're using as well. So without further ado, let's break down what he is saying. So we just heard him talk about that magic number. So that magic number is the PMI. And what he is saying, if the PMI crosses below 47, there is a 100% chance of a recession. The way he views the PMI is a leading indicator of GDP, which is a lagging indicator of the economy. So looking at the GDP means you would always be very slow. So instead, we should always be looking at the PMI. That is what he believes, and that's how he built his entire investing business cycle portfolio on. Now, the PMI is released on the 1st of every month, and as of 1st of September, the PMI has stayed flat. So we can see it is declining, which is a scary sign, and right now it has stayed flat at 52.8 for the past 2 months. We can see that the decline is not there. So when he's talking about the leading indicators of PMI, the way that he builds it is based off the ISM and the S&P 500 year on year. So he maps out how they track, and based on the price, based on the market price, he then would tabulate what level is the market expecting. So based on his research, he finds that the market is pricing in a level of 47. That's just how he tracks it. I don't really know exactly how he formulates it. I have my own way of formulating it as well. But this is where I have my own way of viewing it as well. But this really depends on what kind of data you are looking at. Let me zoom in on this. I have my own way of viewing the charts. But this is where, again, individual interpretation comes in. So over here, again, I put over the PMI and the S&P 500 year on year, following what he says and the way I want to do it. I can't get it to track the way that he does, perhaps because I have limited data and I don't have a team of macro investors to look at. But this is how he generally tracks. So based on the S&P 500 year on year change, based on a monthly cycle, he then gauges where the PMI is being priced in. That's how he calculates it. So he maps over the S&P 500 year on year, and that's how he tracks. So this is the first point. Let's take a look at the second point and see what else we can learn. So let's just continue watching what else he says, and then we'll head over into an actionable plan. If you want to follow what Raoul Pal thinks and you want to subscribe to his macro theory, this is what you can do.
So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows. Now, if that is the case, then most people are positioned for it. So therefore, the path of pain is the opposite. And I think the market's priced that in. So I think there's no certainties in this world. I can be wrong. But my view, the balance of probabilities are for me that the risk asset market, equities, crypto, have bottomed. We are having a retest. And as the economic data shifts and bond yields come down, that'll drive that further, and it'll be a further hated rally because nobody will understand. We're going into recession. Why are equities going up? Well, because they already priced the recession. It's their job to be forward-looking indicators.
So what he is saying here, based on the current price chart, he thinks that we are close to the bottom. Now, why is that? He's saying that risk assets, especially things like crypto, we expect them to bottom out much earlier. There's another talk by someone else that describes that usually the bottom of the market arrives around the 2/3 mark of a recession. So if a recession is going to last for 2 years, we could start to bottom out around here. And that's what Raoul Pal thinks. And why does he think that? He thinks the bond yield is going to drop, which means liquidity is going to re-enter the market. And when that happens, we will see this pump. And I agree with that statement wholeheartedly that when we see the Federal Reserve start to print more money again, I do believe this is going to be up for a massive bull market. And so if you are watching this and you are aware of this, keep an eye out for it because it's going to be the biggest bull run in history. But until that happens, we may just be stuck here. So 70% of all respondents, based on his survey, reports that they feel that equities are going lower. Now, everybody thinks that means that it has already been priced in. So what Raoul Pal is saying is that the risk to reward ratio is favoring at the moment if we go long. And this, again, for him, he's looking at a macro between 6 to 18 months. So keep that into perspective as well. He foresees is that there will be a continuous market rally and the economy is just going to go down and people are going to be so frustrated because why is the economy doing bad, but stock prices and asset prices like crypto and especially risky assets are going up? Well, he's saying that the market has already priced that in. Therefore, what we are seeing now, this drawdown over here of that 20% drawdown, this is already pricing in the recession. And what he is saying, between here and all the way up, the market is going to price in a Federal Reserve pivot. I know that's what he means because he's saying bond yields drop. When bond yields drop, that's usually when the Federal Reserve flips and starts printing money or dropping interest rates. So two things right now, the PMI and that the bottom may be in. That is his two main points.
Once you start seeing your forward-looking indicators of ISM, which are usually the subcomponents of ISM, plus other stuff, like freight rates and shipping and car sales and whatever it is, what happens is you can start to predict when markets will act in a certain way with more confidence. Nothing is perfect. Things fail, things change. There's other parts of the equation you miss, but it gives you a really much higher probabilistic odds, which is why I'm really comfortable investing in the 6 month to 18 month time horizon versus the 1 week, the 3 months, because I find the economy the best driver. Now, it's also a great arbitrage, because almost all the capital in financial markets and all of the models and systems and algos and hedge funds are all working on the intraday to 1 to 3 month time horizons, because that's when they have to report to their investors.
I kind of agree with the last part. It's due to the nature of the reporting schedule that most algorithms are tailored and most hedge funds are tailored to the 3 month, maximum maybe 3 month schedule, which means that some of them are willing to take shorter term gains, even though they're going to be positioning themselves much worse in the next 6 to 18 months. So what he is saying that he likes to look at the ISM because the ISM allows him to then take a longer term view and arbitrage that market inefficiencies between the 6 to 18th month mark. He feels that if you look out to the 6 to the 18-month horizon, then it is much easier for you to predict and it's much easier for you to then trade in the longer term. Well, if that's what Raoul Pal thinks, then what is his position right now? Is he going to go long? Is he going to go short? What is he thinking right now? Let's take a look at what he said.
Yeah. Let's jump around here a little, Raoul. And the question is, why buy now if recession is certain?
Because the market's job is to forward look. If I can see the turn in the data already in liquidity conditions in February or March of next year, the market can too, even though most participants can't, which is why the market always confuses people. The market generally bottoms before a recession. It's normally 3 to 6 months. Sometimes it's been a year beforehand. Other times it's been in line with the economy. So my guess is the market has seen the low.
Do not take these words verbatim, all right? But he's trying to hint that we should start buying the market now, and it's because the market is forward-looking. If all else stays the same, just based on liquidity forecasting, some analysts, including Raoul Pal, predicts that there will be an increase in liquidity coming in 6 months' time. And the markets will try to price that in earlier, even before the recession is over. The point here is that the market will start to bottom before the economy starts to recover. So we need to position ourselves well in advance, especially if it's risky assets. So we have seen how Raoul Pal looks to the future. So we have seen what Raoul Pal is looking at when he's trying to plan for the future. We have seen that he is on a bullish bias as of right now. So what asset classes is Raoul Pal looking at and what is he bullish on? Now let's take a look. This is going to be key, all right? And afterwards, I will try to break this down a little bit further and maybe in another video.
Does Raoul think TLT is a good investment? And if so, what's the hold period? We should say iShares 20 plus year treasury bond ETF.
I like bonds. That's a decent way of playing it. You know, manage your own risk. You run your own trade. I run mine. But I think the time horizon I'm looking for interest rates to fall, it usually goes through recession and through the other side. And so I would imagine that it's a decent trade for 9 months. But we need confirmation that this bloody bond yields are turning or the TLT's turning, and we're just not getting it yet. So it's frustrating as hell for me right now, but let's see.
All right, so this is what he's looking at right now. So Raoul Pal is going to long bonds. Raoul Pal feels that bond prices would go up. Why? Because the yield right now, let's open it up. So the TLT is the ETF which tracks the 20-year plus treasury bonds, which have fallen sharply after interest rates rise. And he feels that he is going to long this chart. Now, what has happened? So since it's high, we can see that it has fallen almost 40%. Now, why is that the case? Because bond yields, let me open up my indexes. The bond yields, especially 20-year yield, as you can see, has been going up. So what the market is doing right now is it's pricing in that as of today, the Federal Reserve will push rates up to a 3.6%, which we are not there yet. We will need at least 2 more rate hikes if we are to reach 3.6. And he predicts that it will not touch 4%. He predicts is that because the economy is going to do bad, they're going to have to drop rates back down to 0. And when rates fall down to 0, the TLT, which is inversely related to bond yields, is going to then skyrocket back up. And so what are we looking at right here? We are looking at about a 40-50% return if you are doing it on the TLT. And what is the downside from here? The downside is based again on the yield. And he thinks, based on another video, it's not captured in this video, he thinks that the bond yield may only go up another all the way to 4%. And if the yield goes up to 4%, we can see the TLT fall even further. But by how much? How much more can this fall? This is just a very, very bad illustration, by the way. We can see that for a 0.5% move, we lose about 10%. Again, this is a very, very bad estimation. I did not do the calculations before this video. So we can anticipate another drop. So if we just draw it down another 9%, that is, if we do it another 9% down to just around the $100 level, that is not very good. But what is the upside? If interest rates were to go all the way back down to 0 and stay there, then our upside is almost 46%. So the risk to reward ratio based on Raoul Pal's major understanding and play is 1:4. Now, I personally like those odds. I have a feeling it will play out. But again, as Raoul Pal says, he hasn't found the turning point yet. He hasn't seen this start to fully curve around, which means the entry point, if this was going to be the entry point, it would have been a push up, a retrace, and the entry point was supposed to be here. But what we see is that it broke through, which means there is no upward trend. Now, Raoul Pal wants to see a reversal, a full reversal, before deploying a sizable amount. He probably isn't going to use the ETF to trade bonds considering his position size, potentially options, or maybe even buying the bonds directly. But he feels that a 9-month trade horizon is a good option. But again, it will only happen if what he thinks the economy is going to do plays out the way that he thinks. We can get into preemptive position now, but even Raoul Pal isn't doing it. I'm not sure if he did. He didn't really say whether he's been getting into the positions, so we shall see what lies ahead. But the market is pricing in another 1 and 2 more rate hikes. So it is very important that we pay very close attention to rate hikes. I will probably try to break this down deeper in another video, which will help us prepare what we need to look for and when do we want to allocate money into bonds, and is it worth it? And is it worth to take leverage? Is it better to buy TLT bonds? Is it better to buy options? And if it's options, how can you use options to protect yourself if the trade goes against you? What is the worst case scenario? And I hope that will help us understand how to take part in this trade if you have conviction in this area. But you must also understand that Raoul Pal is biased to a short-term, shallow recession. That is his thesis right now. And if that doesn't play out, his bond theory may not play out as well. So based on your own research, maybe some of my research, and listening to other macro investors, you will be able to decide if this is going to be a sticky inflation and a long drawn-out stagflation, or is this going to be a short, shallow recession. Based on that, once you decide which side of the boat you rest on, you can start making a decision on how you want to trade. It is not an easy task, but I am also learning on... It is not an easy task, but personally, I am leaning more on Raoul Pal's side, especially being part of the younger generation where we can see with our own eyes that the majority of the workforce is leaving the market. And we are moving into a new era where there would be more deflationary forces coming. So subscribe if you like these kind of video breakdowns where I analyze interviews of people who have macro perspective and then try to break it down into how you can apply it into your trades directly. I hope that then I can give you the setup. Again, none of this is financial advice. You should not take, again, one person's perspective to trade. I can tell you what I am doing, the reason for my convictions. And if you ask me, well, I'm buying bonds tomorrow. I do see an uptick. This could be a double bottom and then it rallies. Raoul Pal may be right. But we wouldn't know. We wouldn't know. That is just, again, one man who is very biased to one side. Other people who are biased to that theory is maybe Kathy Wood, maybe Chamath as well. I do really subscribe to what they say in terms of macro perspective. They generally have been right all along. So it is up to you whether you want to follow them. So I hope this has helped. I hope this is not too in-depth. I'm trying to make it simpler. So I'm trying something new and I want to take the information that I'm learning and share it directly with you guys. I hope that this isn't too difficult. It is easy to understand. Then I will go into a more in-depth video maybe in the future that breaks down exactly what to do. What does he mean by all of that? And what are the trade setups that we can look for, especially if we're looking at a 6 to 9 months horizon? Let's break down what the most intelligent people in the world are thinking of and see how we as retail traders can then take advantage of that. And with that, so if you'd like to see that in the future, please subscribe. I put a lot of effort into these videos and I really try to make sure that it's applicable to everyone here as well. Ciao.